Good morning, friends. We have seen the previous session on the participants of securities market, and then we have started with the stock market indices, and then we have seen about the various methods of constructing stock market index. So today we will see in detail regarding the construction of stock market index, namely price weighted index, equal weighted index, and value weighted index. Before we go in detail of calculating the entire part, we just wanted to brief you on stock market index and various stock market indices in the world, and how this stock market index is very important parameter for evaluating the market performance. So as we have discussed earlier, stock market indices are the important parameter for evaluating the individual stock market performance. If we go for individual stock, we can find out what is the opening price and what is the closing price, and we can find out the return. So like this, an investor cannot find every stock return. So we have about 9,000 plus companies are getting listed in the exchanges. So it is very, very difficult. So as an exchange, the exchange has to provide a broad market behavior to the investor. So how they can communicate? They can communicate through index called stock market index. So it is an indicator which provides the broader behavior of stock market. So every country has got its own stock exchanges, and every stock exchange has got its own index. Okay. Now, stock market indices are the barometers of stock market. They mirror the stock market behavior. It provides a summary measure. It provides summary measure of the behavior of stock price and the stock market. So it doesn't provide the individual stock market performance. There are three, as we have discussed earlier, there are three methods of constructing stock market index: price weighted, equal weighted, and value weighted. This index we will see in detail. The main objective is to help and analyze the movement of the prices, and it provides the return on index. So when we say what is market return, so stock market, individual stock return means you will find out closing price and opening price. So how do we find the market return? Market return is reflected through stock market index. Market return is reflected through stock market index. And we have industry-wise indices. So we have a bank index, we have a capital industry index, we have oil and gas index. So every industry got its own index which takes into account only that particular company. So these are all major popular stock index that we have. Sensex, that is, as we have discussed, it is called sensitivity index. So the broader term is sensitivity index. Acronym is called sensitivity index. We call it as Sensex. S-E-N, EX is added. So sensitivity index. So it is started in 78, 79. So we have, this particular exchange index started 78, 79. And it is a value weighted index. The third method is a value weighted index. It is not a price weighted index. So it's a value weighted index. Sensex is taken only 30 companies. So why these 30 companies? 30 companies of large capitalization. So based on the market capitalization, or we call it the based on market value of the company, the companies are classified into three broad categories. Based on market value, based on market capitalization, the companies are divided into three broad categories. One is large cap. Second one is mid cap. Third one is small cap. Large cap, mid cap, small cap. Now, how do we get the market value of a company? How do we get the market value of a company? Market price per share multiply with number of shares traded in the market. Market price per share multiplied with number of shares traded in the market. As we have discussed earlier, what is a public float? What is a free float? when the company comes for listing, what is the free float? Anybody?
For all the shares present in the market.
No, what is called free float? How much percentage is the free float? We discussed the previous session. Free float or public float. What is the free float?
25.
25. Very good. 25%. The free float. That means the company has, say, 1 lakh shares with the registered capital. All the 1 lakh shares will not be issued. It will not be issued to the public. But this week, this particular week, between 9th and 13th, 4 companies are there in the market for IPO. This week itself. So it's a IPO rains. IPO rain is going on. So many companies are coming for IPO. This week itself, 4 companies are there. One Chennai-based company to Delhi-based company. It's coming for IPO about for 18,000 crore. So when these companies coming for IPO, all the company shares are not issued. Maximum, the company can go up to 25%. Okay, so why sir maximum 25%? Why not 30%? Why not 40%? That means the control over the company gets diluted. You are inviting more owners in the company. So in that case, the company cannot take the special resolution. To pass a special resolution, the company should have 75% of shareholders. The company is going for expansion, the company is appointing new CEO of the company. That means the company has to pass a resolution. So that special resolution, the company requires 75% shareholders. If it is an ordinary resolution, the company should have minimum 51%. 51%, more than 50%. 51% the company should have. So to pass special resolution, the company should have 75% shareholding pattern as per the Companies Act. So to keep up that, some 25% the company can keep. Maximum the company can dilute. Okay. So number of shares, for example, 1 lakh shares the company is having, 25,000 shares are issued for the market. Remaining 75,000 shares are kept with the promoters, kept with the board of directors. So this 25,000 shares only the company need to take for calculating market value. So what is your market value? Market value means number of shares traded in the market, not total number of shares that you have. The company may have crores of shares, but how many shares are traded in the market? So which company will have market value? Which company will have market value? Does Flipkart have market value? Does Flipkart have market value? Or the bus that we are traveling, BMTC, does it have market value? Why? They are not listed companies. So unlisted companies do not have market value. Unlisted companies do not have market value. So only listed companies have got market value. Why? Those company shares are traded in the market. Okay. So market price per share into multiplied by number of shares traded in the market. So in this example, the number of shares traded in the market is 25,000 shares. See, for example, the market price per share is 100. So 100 into 25,000. That is called market value. Or we call it as a market capitalization. So market capitalization or market value are one and the same. So based on market capitalization, the companies are divided into three broad categories. Large cap. That means if the market value is more than 20,000 crore. If the market value is more than 20,000 crore, it is called large cap. If the market value is between 5,000 crore to 20,000 crore, it is called big cap. If it is less than 5,000 crore, it is called small cap. All of you got it? So large cap means what? The company's market value is more than 20,000 crore. So how do we get the market value? Market price per share multiplied with free float. Multiplied with the free float. Free float means number of shares traded in the market. If it is more than 20,000 crore, it's called large cap. 5,000 crore to 20,000 crore, it's called mid cap. Less than 5,000 crore, it's called what? Small cap. Okay? Companies like TCS, HDFC Bank, Infosys, Reliance Industries. So these companies, market capitalization, anybody? Rough figure. Rough figure. Online, students. Some rough figure. Infosys, market capitalization, market value. Anybody? HDFC Bank. Reliance Industries, market value. Just rough value, just say one value, no. Online. Online students are hearing, no? Hello? Students are online?
Yes, sir. Yes, sir.
Yeah. So, what's just rough figure you say?
1 lakh crore.
Huh?
1 lakh crore.
Around lakhs crores, sir.
How much?
Around 5 to 6 lakh crores.
Oh, very good. Excellent. Oh, what is his name? What's your name?
Uday, sir.
Uday. Okay. Say C-section, huh?
Yes, sir.
So I cannot give you 2 marks. 1 mark we can give you. Okay. C-section student can give 1 mark to him. Representative can give 1 mark. Uday will get 1 mark. 7 lakh crore. 7 lakh crore. 7 lakh crore. Just find out how many zeros are there. Zeros are there. Okay. So I mean, these are all these 4 companies what we have discussed. I mean, mentioned. All have got more than 7 lakh crore of the market value. Number of shares in the market multiplied with the market price per share. So Sensex will have only large cap. 30 large cap. Sensex 30 companies which is highly traded and high market value companies will be part of Sensex, which represents all the industry. No industry should be left over. So this Sensex or Nifty or any index provides the broad market behavior. That means all the companies need to be included. So all the companies they cannot include. That is not called index. So they should select the specific companies who are industry leaders. Say for example in that IT industry, these are all the industry leaders in our country. TCS, Infosys and Wipro, and all these are currently part of Sensex. They are all industry leaders. So predominantly the industry leaders of different sectors will be part of Sensex and Nifty. So when we say Sensex and Nifty, predominantly they refer to what? Large cap companies. I mean the companies which have got more than 20,000 crore market capitalization. But these companies have got far ahead of 20,000 crore, more than 7 lakh crore they have a market capitalization. So they are part of Sensex and Nifty. So being part of Sensex Nifty is a pride for the company. So the company value surely increase because they are part of the major index of the country. The same way we have national index. So national index means how many companies are there? 100 companies are there. So the larger the companies are there in the basket means the index, the better reliability it is. So the reliability of an index depends on the number of companies included in the index. The more companies are there, the index will be more reliable and we can take for any kind of research work. So when we go for our research work, we cannot take Nifty. Nifty means only 50 companies, but for the convenience sake we go for Nifty, but we need to go for little higher index. So we have Nifty 100, Nifty 200, Nifty 500. That means the 500 companies are there, which includes both large cap, mid cap and small cap. Okay. Then we have Nifty. Nifty means 50. Nifty means 50. Okay. So it is how it has come S&P Nifty. Usually it is called S&P Nifty. S&P is Standard and Poor. Standard and Poor. It's a credit rating agency in the US. The credit rating agency in the US helped the National Stock Exchange to come out with this index. So they kept the name as S&P. So they helped the company in 2003, way back in 2003, to construct this index. So they have kept their name as a prefix in the index name, CNX Nifty, it started in 1995. It starts with what? 1,000 companies. So how many companies are included? 50 companies are included in this particular index. Then we have Economic Times newspaper. Only one newspaper which has got index in our country is Economic Times. So Economic Times newspaper has got its own index. It's called ET index, which has got 72 companies. 72 companies. They follow equal weighted index. They follow second method called equal weighted index. Then we have a Financial Express Equity Index that is not common. Then we have Dow Jones. Dow Jones is the US index. US has got two major index, as we have discussed earlier, Dow Jones and S&P 500. So Dow Jones, which follows price weighted index. Price weighted index, first method they follow. They take 30 large cap companies, Facebook, Apple, Microsoft. These are all US based companies. All these US based companies are part of this Dow Jones index. Okay. And then S&P 500. So S&P 500 means another index, Standard & Poor. The name itself indicates now how many companies are included in the index. 500 companies are included in the index. So when we compare to S&P 500, Dow Jones, which is more reliable, Dow Jones or S&P 500? S&P 500, because it has got more companies. Okay. Then we have every country has got DAX. DAX is a German index, Germany index. CAC, which is a Canada index. Nikkei 225. Nikkei 225 is Japan index. I mean, the name itself it shows how many companies are included. What is that? 225. 225 means they have taken 225 companies. Nikkei 225. Then we have UK. UK index is called FTSE. 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 So Nikkei follows what? Which method? Japan index follows the first method, price weighted index. Sir, why they follow first method? They follow that method. You can follow any one of the method for constructing your index. It is not necessary that all should follow one index. Nikkei they follow, Japan they follow the first method. Then FTSE, UK index, which is 100 companies. FTSE, why it's called FTSE? Because it's developed by Financial Times of London. Financial Times of London only developed this index. So it is called the FTSE index, which has got 100 companies in the index. They follow the value weighted index. What is that? That's what we follow. In our country we follow Nifty and Sensex, we follow this particular method. Okay. So these are different index that we have around the world. Every country has got its own exchange and every exchange has got its own index. Okay. Now why this variation? So one is Nifty is trading at say 16,000 plus and the Sensex is trading at say 52,000 plus. Why that variation? So all are index only. Now why one is trading at one figure, another one is trading at another figure. So index is an absolute figure. It is not. It doesn't reflect any rupee. Index is not rupee. It's not rupee terms. It's an absolute number. Okay. So why that variation? The variations are due to the following factors. One, the number of companies included in the index. The number of companies included in the index. Sensex has got 30, this has got 50. So because of that variation. Second factor is the year in which it is started. One index is started 78, 79. Another index is started in what? 2003. The year in which it started. And third factor is the weight of each company in the index. Weight of each company in the index. If I say you don't understand the weight of each company in the index, let me go to Moneycontrolcom, which will give you the complete structure of how each companies are included. That Moneycontrol.com will be the best website that you can see for our calculation part. Moneycontrolcom. This is a company which is kept for IPO today. A Chennai-based company. Oh, it's going. Chennai-based company is going for IPO nowadays. This students in online, you can see here. 1 minute. Let me share. Yeah. Students online, can you see the website? Hello?
Yes.
Yeah. So this is a moneycontrol.com website. You will get all the related information about the market from moneycontrol.com, free information. You will not pay anything here in this particular this one. So you go here down. So IPO snapshots, you look at the IPO, these are all IPO, what I'm talking about, 4 companies are there. Novex Vista, Apetus value-based company, which is Chennai-based company, which is meant for the self-employed people who cannot go for housing, moderate housing. Because when you go for a housing loan, the bank will ask for so many documents. So this company is catered to self-employed people who wants to have his own house. So even self-employed person, entrepreneur who is doing one petty shop he has got, one pan shop he has got. So he is wish to have his own house. So he cannot go for housing loan. Why? Because a lot of restrictions are there when you go for housing loan in the bank. Because you have to produce a salary slip. Because you have a shop, where you get a salary slip? You don't get a salary slip. And you may not have a security to give it. So this particular company caters to the need of self-employed people who are going for moderate housing. A Chennai-based company is going for IPO today, is going to get about 2,734 crore. So IPO is coming. Then Chemplast is another company which is coming for IPO, so which is also Indian, Chennai-based company. So you come down here. So look at here, markets down. Down, that's a markets, correct? So click this markets. You'll go to all the markets here. Okay. So this is very, very important because the case studies, your assignment, all that, you will have to take it from here only. Okay. So click this Nifty. Click this Sensex. Sensex here. Okay. Sensex now trading at 54,219 now. You will have Indices, you click. Here, look at this. You will get the number of companies here. Have you seen the Sensex companies? Have you seen here? So look at the company. Have you seen that? Okay. So look at the companies. So it's a real-time market. Asian Paints. Which company? What is the which sector? Asian Paints. Asian Paints. Hello. Asian Paints. Which industry? Huh? Asian Paints. Which industry?
Paint industry.
Paint industry we don't have. Construction. Real estate. Then Axis Bank. Bank industry. Bajaj Auto. Automobile industry. So all the industry will be represented in the index. No industry will be left over. Okay. Then you have Bajaj Finance, NBFC, non-banking financial institutions, NBFC. Then you have Bajaj Financial Services, again NBFC, Bharti Airtel. So only we have two telecommunication companies going to exist. Bharti Airtel, telecommunication company, Dr. Reddy's Lab, which industry? Pharmaceutical industry. HCL Technology, IT industry. Hindustan Unilever, HUL, FMCG, Hindustan Unilever, all your soaps. ICICI Bank, banking industry again. IndusLand Bank, banking industry, private bank. So all private banks. Infosys, IT industry. ITC, FMCG. Kotak Mahindra, automobiles. Then Larsen Tobro, capital goods. L&T, capital goods. Capital goods, they manufacture the bulldozer, capital equipments. They go for construction. So it's a capital goods industry. It's a conglomerate industry. Then we have MMM, Mahindra and Mahindra automobiles. Then you have Maruti Suzuki, again automobiles. Nestle, FMCG, NTPC, power, government company, NTPC, National Thermal Power Corporation, power industry. Then we have Power Grid Corporation, again government-owned company, power company, Reliance Industry, conglomerate. They don't reflect oil and gas, construction and capital goods, textile, so conglomerate. Reliance Industry, Sun Pharma, pharmaceutical, Tata Steel, construction, TCS, IT industry, Tech Mahindra, IT industry. Then we have Titan company, which is recently included. Okay, they are into what is that? Watch. It's not related to FMCG. They are into convenience goods. Then we have a Ultratech Cement, is a construction industry. Okay, so all the industries are included. So when you go, all the industry sectors included. So when you come here, let me see. When we go here, see, look at that. You have percentage of change related prices. You find here market value. It is not given here. Okay, so volume, sale quantity is there. So you find the market value of these companies. Market value is not mentioned here. So market value means the number of, what's the total market value of each company. So this market value of Asian Paints, when we go to Nifty, okay, so I'll go to Nifty 1 minute. So you go to Nifty. So all these are also here. S&P, on the left hand side when you look at here, you find S&P BSE small cap. What is that? S&P BSE small cap. So what's the index called? S&P BSE, so Bombay Stock Exchange Index. Small cap. Small cap means what?
Below
5,000 crore. So for that category we have an index. See, in Sensex will have only the large companies. Small companies cannot be part of the Sensex. In nowhere you cannot be part of that. You cannot have 7 lakh crore, 8 lakh crore market value. You cannot have that. Okay. So for them you have another index. For that category, you have another index called S&P BSE small cap. Then you have, look at that, S&P BSE mid cap. What is that? It is for mid-sized companies. Okay, so mid-cap companies cannot be part of Sensex. So for them we have a separate index. Okay, S&P BSE mid-cap. Then you have, like this, you have a S&P BS selected index. Only particular company only selected companies. Then you look at here, down when you come here, you have a sector, say S&P 100. 100 means how many companies? 100 companies. S&P BSE 200, how many companies? 200 companies. S&P BSE 500. 500 companies. Then you find sectoral index. Each sector has got its own index. So you want to buy or you want to analyze certain banking company performance, you can take sectoral index. So that particular index is called here, what is given here? BankX. Have you seen? S&P BSE BankX. That means what? Only banking companies will be part of this particular index. So that we will find out the sectoral growth. BankX. Then you find, next one you find auto. What is that? Only automobile companies. Only automobile companies you find. Then you find basic materials. Cement. Those basic materials. Capital goods. Capital goods. I mean L&T, such kind of big capital goods companies. Okay. So like this you find only that particular sectoral index. Then you go, so like this you have got so many index you find here. Oil and gas you find here. Then you go to NSE. You click NSE here. All NSE index you will get. Okay. You get NX index. I'm showing you because it's required for your assignment. Assignment, real-time assignment. So you'll have to take the values from here only. So S&P here. So now I'm taking the Nifty now. So Nifty, look at here, 50 companies. So Nifty means Sensex plus 20. What is that? All the 30 companies of Sensex plus 20 extra. So all the companies of Sensex will be part of Nifty. Then they have taken 20 companies extra from different sectors. Okay, that is called Nifty. So look at that here. Asian Paints, the Adani Ports. Adani Ports, which company? They are into what? Harbor. So the ship company is not there in Nifty, in Sensex. It's not there. That industry is left out because you can take only 30 companies. Okay, so this sector is not that much prominent sector. So that is excluded in Sensex. Here it is included. Okay, Adani Ports, Asian Paints, it was there in Sensex?
Yes, sir.
Asian Paints was there. Axis Bank was there in, it was there in Sensex. Bajaj Auto, it was there in Sensex. Bajaj Finance, it was there. Bajaj Financial Services, it was there. Bharti Airtel, it was there in Sensex. BPCL, it was not there. Oil and gas, it was not there. Here it is included. Oil and gas, a government-owned company, BPCL. Then we have Britannia, it was not there. Nestle was there. Britannia was not there. Britannia is included here. Okay. The country head of Britannia is, the South India head is from our alumni, Britannia. Cipla was not there. Pharmaceutical, only Sun Pharma was there. Dr. Reddy's lab was there. Here, Cipla is there. Bangalore-based company. Cipla is a Bangalore-based company, nearby Kerala. Cipla. Okay. Then we have Coal India. Government company, government-owned company, Navaratna, government-owned company. They are into coal mining. It was not there. Coal mining was not part of Sensex. Here it is part of here, Coal India, government-owned company. Then we have Davis Lab. It is not there. Okay, it is not there. Dr. Reddy's Lab. It was there in Sensex. Motors, Ekir Motors, automobile company. It was not there. Then we have a Grasim, textile industry. It was not there. Raymond's, all that comes from textile company, Mumbai-based company. Then when ICL Intech, HCL was there. HR Head was our first batch. HDFC Bank. It was not there. Here it is part of that. HDFC is different from HDFC Bank. Both are different. One is housing company, another one is a banking company. Both are different. Hero Motor Corporation, it was not there. It's an automobile company. Then we have Hidalgo, aluminium company. It was not there. Here it is there. Hindustan Unilever was there in Sensex. ICICI Bank was there. Industrial Bank was there. Infosys was there. IOC was not there. Indian Oil Corporation, a government-owned company in oil and gas. It was not there. ITC was there. JSW Steel was there. Tata Steel was there. JSW Steel, it's included in Nifty. Kotak Mahindra was not there. Kotak Mahindra is an automobile company. Kotak Mahindra Bank is different. Kotak Mahindra Bank is different from Kotak Mahindra. It's an automobile company, Kotak Mahindra. Then we have Larsen Tobro, it was there. MMM, Mahindra and Mahindra, it was there. Maruti Suzuki was there in Sensex. Nestle, it was there in Sensex. NTPC, it was there in Sensex. ONGC was there? No, it was not there. Government-owned company. Power Grid Corporation, it was there. Power company. Reliance, yes. It should be there. It was a big company. SBI was not there. It was not there in Sensex. It is removed. Now it's part of Nifty. SBI Life Insurance company was not there in Sensex. So Nifty only it has got. So which is more reliable, Nifty or Sensex? Nifty, because Nifty has got more sectors. Nifty has got more sectors than the Sensex. Insurance was not there. Then what is that? Cement company. Only one cement company was there. Here only Shree Cement is there. Sun Pharma was there. Tata Consultancy was there. Tata Motors was not there. Tata Steel was there. TCS was there. Tech Mahindra was there. Titan was there. Ultratech Cement, it was there. UPL was not there. Wipro was not there. Wipro was removed recently. Okay, so here it is there. So all the industries are part of this. Now when you look at here, the point here is the value of, oh, it has gone. One. Where is that? This one. Yeah. Oh, where is it gone? Okay, sorry. 1 minute. Let me take that. The point that I want to stress upon here, is gone, isn't it? Where is that? So I have to go again. The point here is the company which is having value, a weight in one index is different from another index. Say for example, Infosys, the weight, value weight, is entirely different from Infosys in Sensex. Both are different because here you have 50 companies, here you have what? 30 companies. So you total Nifty value. So each company has got market value. Each company has got market value. Okay. You add the total of all the 30. Here add all the 50 companies. You will have a total Nifty value. You will have a total Sensex value. Then you find each company percentage. So for example, Infosys percentage in Sensex. Its market value divided by total Sensex value into 100. 1% will come. So say for example 16%. In case of Nifty also you will have all the 50 companies and Nifty market capital, Infosys market capitalization divided by total, you will get only 11% because here you have got 50 companies. So the weight of each company differs from one index to another index because number varies. So because of these three major factors, one index is trading at say 52,000, another index is trading at say 16,000. Number of companies included in the index. Second one is the year in which it was started. Third one is the weight of each index, each company in the index. The weight of each company in the index varies from one index to another index. Got it?
Yes.
Now we will go for next aspect. We will go for how to calculate this value. Price equal. So we will take one simple case study because if you take the real case study, the calculation will be tedious. So we will go for artificial case study. 1 minute. I'll take that. I'll share you. How it has been calculated for each index. How it has been calculated. Yeah. It is there in the LMS. You can take all these cases from LMS. Or whatever you are discussing, it's there in LMS. You can take it from LMS. Yes.
Can you record the session?
Yes. No, here recording is going on, my dear. Hello? 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 Who has asked? We have recording in our both video. We are recording here. Okay, nothing to worry about. Video we are recording. The entire video is recorded, so you will get that. Where are we now? Sometimes because so many multiple screens I have opened. 1 minute. I'll show you. Okay, now please take this. Hope all of you can see that case. Hello? Well, we can take this case.
Yes, sir.
Okay. Now, you have given 4 companies here. You have given 4 companies, not, 5 companies you have given here. And you have given a price at the base year. Price at the base year. And price of the current, today price. And number of outstanding shares. Number of shares outstanding. So can you please note down so that I will, please note down. Consider data for sample of 5 shares. Consider data for a sample of 5 shares. Please note down. Remaining thing you can leave it out. 4 columns. Share, price in base year, price in year T, and number of outstanding shares. Share, price in base year, price in year T, and number of outstanding shares. Okay. Now A 24, 20, 15. The last column is in millions. Last column is in million. B 16, 22, 8. C 42, 54, 20. 54, 20. D 32, 48, 46. E 18, 12, 12. E 18, 12, 12. What is price weighted index, equal weighted index, and value weighted index? What is price weighted index, equal weighted index, and value weighted index? Okay. One more you take. One more you take. Sample of 5 shares. Share, price in base year, price in year T, number of outstanding shares. Outstanding shares. P, company name is P, 42, 58, 26. 42, 58, 26. Q, 60, 54, 18. 60, 54, 18. R, 24, 36, 16. 24, 36, 16. S, 52, 38, 20. 52, 38, 20. T, 16, 28, 32. 16, 28, 32. Calculate price weighted index, equal weighted index, and value weighted index. So I'll close the screen. I'll switch off. So when I'm moving to the blackboard, can you see? Hello? When I'm moving to the, you can see? Okay. What is that? Share. Company name.
Can't see you, sir.
1 minute. I'll come this side. 1 minute. I'll come little bit this side. Is it okay here? Can you see me now?
No, sir.
Okay. 1 minute. Can you push this little here so that 1 minute. Brother is adjusting the camera. Now you see. Now can you able to see now? Okay.
No, sir.
Is it a board you can see now? Can you see the board? 1 minute. This is not correct. Yeah. Huh?
That's not connected to this. That camera is not connected to that.
So you have to have that camera. No? correction is not required.
Not required.
Not required, not required. Just
Yeah. It's record experience.
record. No, but thing is,
They can't see it now, but it will come in.
it will come in the YouTube. Yeah, yeah. Okay. Now, what is that? It will be, I mean, what time this one, it will be recorded. It's recorded now. So you can see the YouTube. Okay, you just listen what I'm saying. So it's recorded and the recorded video will be uploaded in the YouTube. Okay. If you cannot, little more move, I think, further, brother, you little more, keep it to the front. Is it okay? Just a little more front. Yeah. Now, can you able to see now the board? Hello?
Yes, sir.
Okay. Okay. So company, yeah. What is that price? Beginning price. Okay. Then you have ending price. Ending price. And then we have free float. Okay, free float. So you have company A, B, C, D, E. So in case of Nifty, how many companies will be here? Instead of 5, how many companies will be here? 50 companies will be here. Okay. Now beginning price, tell me the value. 24.
16.
This is in rupees, okay? 24,
16.
16,
42.
40, 2,
32.
32, 18. Correct?
Yes.
So what is called beginning price? So we need to understand what is called beginning price. Beginning price means the price of a company in which this particular company is included in index. Okay? The company is included in index. So each company may be included in different times of period in the index. Okay, so for example, Nestle got introduced in part of the Sensex last August 2020. Before that, Nestle was not part of Sensex. Okay, so for example, August 3rd, 2020, Nestle was added in as part of Sensex. So what is that price, that day price? That is called beginning price. Okay, so depends on the performance of a company. Some companies will be removed from index, some companies will be added in index from that particular sector. That depends on the exchange. Exchange will decide, depends on the performance of a company. So for example, company which is reporting loss, the company shares which is not traded, not actively in the market, those companies will be removed from Sensex, from Nifty. This is not permanent. The moment you are not, if you are part of Sensex or Nifty, you are not always part of Sensex or Nifty. The exchange will watch the company performance, fundamental performance, its profit, its revenue, growth, all that. Then how often this company stocks are traded in the market. How often, how liquid it is. The higher the liquidity it is, it will be part of this Sensex or Nifty. So if it is not, the company is not reporting loss, the company is not reporting profit, the company's shares are not traded actively, that particular company share will be removed from Sensex or Nifty, a new company will be added. Sensex or Nifty, now and then. That is decided by the exchange. Okay? See, for example, Nestle was included last year. So that year, which date it got included? It was included in August 2nd. So that August 2nd price is called what? Beginning price. So beginning price is not today's price. It is not today's price. That we should understand very clearly. Beginning price means the year, the date in which the particular company is part of the index. That's called beginning price. So is it fixed or is it changing every day?
Fixed.
It's fixed. It is constant. It doesn't change. Every day doesn't change. Whereas today's market price, ending price, this will change every minute. Every second it will change. Okay? So tell me the price.
20.
20.
Huh?
20.
20,
22.
22,
54.
54,
48.
48,
12.
12. Okay? So So what is free float? The number of shares traded in the market. All the shares are not in the market. Only how much percentage?
25.
25%. Maximum. Maximum 25%. Okay? So can it go beyond 25? Possible. You can go beyond 25, you can go, no problem. It can go up to which percentage? You can go up to what percentage? 49. You cannot go beyond 49. What happens if you go beyond 49?
No,
You are not the owner. You are not the owner of a company. Somebody will become owner of a company. So you should have minimum of how much? 51. So the range is between 51 to 75. So if you want more funds, you can always dilute. You can always go for FPO, or we can go for private placement. We can go for QIB, qualified institutional buyers. We can go for FPO. A lot of options are there for the companies to raise funds. Okay, you can go up to what? 51. So if you go less than 51, then we are not the owner of a company. Okay, so free float means number of shares traded in the market. This is not rupees, this is what? Number. Rupees in million. Okay? It's not rupees. This is the rupees. This is what? Number. Okay? So how many? 15 million shares. 8 million shares. 20 million shares. 46 million shares. 12 million shares. Okay? Now, for price weighted index, add the year beginning and year end. Add the year beginning and year end. Add the year beginning and year end. How much? Year beginning how much?
132.
132. Year end?
156.
156. 156. Aggregate of year end, aggregate of year beginning. So price weighted index will be 156 divided by 132 into 100. That's called price weighted index. Aggregate of price at the end divided by aggregate of price at the beginning, multiply with 100.
118%.
8%. 118. 118%, 118, that's all.
0.181.
0.18. 118.18. Okay? Correct?
Yes.
So what does software do? So driven by software. So what does it do? This is fixed. In software this is fed. It is fixed. It is recorded second wise. Every second it changes. It is recorded. Automatically it got recorded. Already the formula is being set in the software. It gives you the price at real time. Real time price you will get. Okay? So this only it has to be recorded every minute. So it changes at the real time price that you get. Okay? Which index it follows? Japan. Japan follows this index, this method. In US, Dow Jones follows this particular index. Dow Jones follows this particular index. Germany follows this index. DAX follows this index. But Canada follows the value weighted index. Okay? So it is easy. Easy to calculate. You need not, formula is not that much complex formula. Put the formula in the software, whatever you have, it gives you the real time price, real time index value. Okay? Now go to the second method. Second method is what? Equal weighted index, which is not that much common. Most of the countries don't follow. Only few papers they follow their particular equal weighted index. For that we need to calculate price relative. Price relative. PR. It is called price relative. PRICE RELATIVE. Price relative. We need to calculate. So how do we get that? Ending price divided by opening price. Each year we have to, each company we need to calculate. It's called price relative. How the price is related with the beginning price. Okay? So ending price is 20, opening price is 24 into 100. 20 divided by 24 into 100. Okay? How much?
83.
83?
3.
83 point?
33.
83.33. 83.33. Then we have 22 divided by 60 into 100.
137.7.
137.5.
5.
Then 54 divided by 42 into 100.
128.57.
128.57. Then 48 divided by 32 into 100.
150.
150.
50.
150. 12 divided by 18 into 100.
66.67.
66.67. Okay. Add it. Sigma price related. Add the sigma price related. Add the price related. Okay. Sigma price related. Sigma price related. People who are on the online, hope you are understanding. Hello? Okay. Sigma price related. What?
566.07.
566.07.
07.
566.07. Okay. So equal weighted index is equal to 566.07 divided by
5.
5, because what is that? Equal. Divide by 5. Okay. Each one is gives 100. Each one is given 100. Equal weight. So 5 into 100. 5 into 100. So if there is 10 companies, 10 into 100. If it is 15 companies, 15 into 100. Equal weight you are giving. 5 into 100 multiply by 100 because it's for a percentage. 100. Okay. So that will give you the equal weighted index value.
113.21.
113.21.
214.
113.21. Okay, that's a value, index value. If you follow the equal weighted index. Okay, so I'll repeat again. Price relative we need to calculate for equal weighted index. So it's called relative. You need to relate with price. Which relation? Relationship between closing price and ending price. Closing price and beginning price. Sorry, closing price and beginning price. So closing price divided by beginning price into 100. Closing price divided by beginning price into 100. For each year you have to calculate. Aggregate. Sum it. Divide by number of companies into 100. So if you have 5 companies, 5 into 100. 6 companies, 6 into 100. Multiply with 100, which will give you equal weighted index value. Okay. Now the last one is what? Value weighting. That's what we follow. In our country we follow. Most of the countries follow this particular index. That's called value weighted index. So here we need to calculate market value. We need to calculate the market value. Market value at the beginning, market value at the end. So what is called market value? What is called market value? What is called market capitalization? Free float multiply with what? Market price. Free float multiply with what? Market float. What is called free float? Number of shares traded in the market. Number of shares traded in the market. So here we have number of shares. What is that? First one, market M cap at the beginning. M cap at the beginning. Then you have M cap at the end. M cap at the beginning and M cap at the end. So M cap at the beginning. So how do you calculate? 24 into 50. 24 into 50. 24 into 15?
360.
360. Then 16 into 8.
128.
128. Then 42 into
20.
20.
840.
840. 32 into 46.
1472.
1472. 18 into 12.
216.
216. This is what market capitalization at the end.
Beginning.
Sorry, beginning. Then your market capitalization at the end. So what we calculate? 20 into 15, 300. Then 22 into 8,
176.
176. Then 54 into 20,
1080.
1080. 48 into 46. 48 into 46.
2208.
2208.
Anything, sir.
What is that?
It's not visible, sir.
Yeah. Please, what I do is multiply free float. It's a video is being recorded. It will be uploaded on YouTube. You can see from YouTube, no problem. It's completely recorded. You can see the board clearly. For your understanding level, you multiply free float with the market price at the beginning. Then multiply free float with the market price at the end. You will get market capitalization at the beginning, market capitalization at the end. Got it? Vaishnavi, got it?
Yes, sir.
Multiply free float with market price at the beginning, then multiply market free float with the market price at the end. Okay? So you will have, last one how much? 18 into 12?
144. 12 into 12.
12 into 12, 144. Yeah. Sum it up. Aggregate. Aggregate the total.
3060.
So market capitalization at the beginning 3000,
60.
3060.
Yeah.
This is not at the end
3908.
3908.
Sorry.
3016, sir.
30?
16.
Okay, 3016 and 3908. Correct?
Yes, sir.
So equal, value weighted index is equals to market capitalization at the end divided by market capital at the beginning into 100. Okay? That means value weighted index VWI is equal to 3908 divided by 3016 into 100.
129.57.
129.57. 129.57. That's the index value. So what does the software do for our Sensex Nifty? All these 30 companies are there. 50 companies are fed here. It doesn't change. The number of companies, the name of the company doesn't change every day. It changes, but not every day. The company is not performing well, the company's stocks are not traded actively, then those companies are excluded from the index. Okay? That doesn't happen every day. It happens once in a while. Okay? So this is fixed. Number of companies are fixed. And names also fixed. Beginning price also fixed. So this is also what? It changes every second. The free float, does it change every day? The number of shares trade in the market, it doesn't change every day. It is fixed. You are not diluting, you are not selling the shares every day. The companies are not selling the shares every day. Investors are selling and buying. Companies are not selling every day. So this free float is fixed in the software. So what the software does, the denominator is fixed. Denominator is fixed. 3016 is fixed. This is fixed, it doesn't change. Okay, so what changes? Denominator changes. Denominator changes every second. Okay, numerator. Numerator changes every second. So the software does it, and software gives the real-time value. This is how we get the value, a real-time value where you get it. Okay, so 3016 doesn't change. So only what change happens is 3908. So it changes, software records it and gives us the value. Okay, so when you look at any index, it doesn't vary very much. See, this is price weighted is 118.18. This is 113. This is 129. There is no much variation. So matter of 16 values only. The lowest is 113. The highest is what? 129. So it is what? Only matter of what? 16. Only the value changes. Whatever the method the exchange follows, the value doesn't change much. Whether you follow price weighted, equal weighted, or value weighted. But among all the index, value weighted is superior method. Value weighted index is very superior method because it takes into account the free float. Takes into account the free float and takes into account the market value of a company, so which is a superior method. Okay, that's why we follow in Sensex Nifty, we follow these two, this particular method, value weighted index. Okay. For examination point of view, it's very, very important. And how this, market behaves as a student in finance, that we need to understand. Though it is not part of your syllabus, so we need to understand how the index, you get the value of index. Somebody is saying 53,000, 16,000. How this index, how this value is calculated. Simply, there must be a scientific way of calculation. Simply the value doesn't come. Value doesn't come simply. There must be some scientific calculation. Scientific calculation is this. How is it calculated? Okay. So any clarification, anybody? All of you understood?
Yes, sir.
Online class? Anybody who has got any doubt? Any clarification? Anybody? Offline, all of you understood?
Yes.
Calculation part?
Yes, sir.
So anybody? So we have seen Sensex component, what are the companies are there in part of Sensex. Nifty, what are the companies which is part of. Each sector has got its own index. Okay? It is based on the market value these companies are part of this index. Most of the companies are, we call them as the blue chip companies. So blue chip companies are large cap companies, which is having high growth in revenue, high growth in profit, highly active traded shares in the market is called blue chip companies. Blue chip company shares. Okay. So predominantly all the large cap companies are called what? Blue chip companies. So any clarification, anybody? Any doubt, anybody? So we'll have 5 minutes break, then you can come back. So we'll have 5 minutes break. So we will. Okay. So we'll have 10 minutes break. Please come back. 11:40. Please come back. Tell me the company. Company. Yeah. So this beginning price. Ending price, free float, market capitalization at the beginning, market capitalization at the end. Okay, so P, Q, R, S, T. Yeah, price relative also is there. Price relative. So beginning price 42,
60,
60,
24,
24,
52,
52,
16,
16,
16,
16. Then we have
and 58,
58,
54,
54,
36,
36,
38,
38,
28.
28. Okay. Calculate the price weighted index. Now is it okay? Is it okay? Now, so you can see that. Yeah. So what is the price weighted index?
190.
The sigma P0. Sigma P0, how much?
194.
194. Sigma PT, current market price,
14.
214. Okay. 214. Students, can you able to see the board now? Hello? Can you able to see the board now?
Yes, sir.
Yes, sir.
Okay. So, next case we are going. That is the total of all the price. Add the total of all the price, beginning price and total of the ending price. Okay. So now 194 is the beginning price. 214 is the ending price. Yeah. So price weighted index. Price weighted index. Can you see the board now? Hello?
Yes, sir.
Yeah. So price weighted index is equal to sigma PT divided by sigma PO into 100. There is 214 divided by 194 into 100. How much?
110.3.
110.31.
1.
110.31. Okay. So anybody, any clarification? Anybody? Anybody, any clarification?
No, sir.
Okay. Now go to the price relative. So price relative relation price of ending price to the beginning price. Okay. So ending price, beginning price, price relative is 58 divided by 42 into 100. 54 divided by 60 into 100. 36 divided by 24 into 100. 38 divided by 52 into 100. 28 divided by 60 into 100. How much comes?
138.
1?
38.09.
138.09.
90.
90.
150.
150.
73.08.
70. 07.
175.
175. So all of you can see the board now? Hello?
Yes, sir.
Okay. So now price relative, anybody has got any doubt? Calculation? Price relative. Anybody has got any doubt in calculation? Price relative? Okay. So add the price relative, sigma PR. 626.16. So EWI, this equal weighted index. Equal weighted index is equal to 626.16 divided by 500 into 100. 120. 125.23. You can take two decimal values. Okay. Okay. Now, tell me the free float. Number of shares in the market.
26.
26,
18.
18,
16.
16,
20.
20,
32.
32. So market capitalization at the beginning. That is multiply free float with the year at the beginning, the price at the beginning. Then market capitalization at the end. Multiply free float with the market price at the end. That is 42 into 26.
1092.
1092. 900. 16, 18.
1080. Not 900. 1080.
1080. Okay.
384.
384.
1040.
1040.
512.
512. Okay. Add it. Sigma N cap at the beginning. At the beginning. M cap at the end. M cap at the end. 58 into 26.
1508.
1508.
972.
972.
576.
576.
760.
760.
60.
896.
896. So sigma market capitalization at the end. How much?
4,700.
4,000.
7,100.
At the beginning, how much? M cap at the beginning?
4,108.
M cap at the beginning 4108. 4108. Here at the end
4,700.
4,000.
700.
4,712. Okay. So value weighted index. Value weighted index. You can calculate here. Value weighted index. Go to. That is 4712 divided by 4,108 into 100. How much comes?
1,114.
1,000. 114.70. 114.70. So anybody has got any doubt, clarification? Anything anybody want to ask? Shall we go next? Shall we go to next?
Excuse me, sir.
Yeah. Yeah, tell me.
Sir,
Tell me, my dear.
sir, could you please repeat the equal weighted index?
Equal weighted index. First you calculate the price relative. The price relative means for each company we need to calculate the price relative. How the price is related with beginning price with the ending price. So ending price divided by beginning price into 100. For each company we need to calculate. For each company we need to calculate the price relative. Ending price divided by beginning price into 100. For example, here for a first company P, ending price is 58, divided by beginning price is 42, 58 divided by 42 in 100. Then second company, ending price 54, beginning price 60, 54 divided by 60 into 100. So for each company we need to calculate and sum up the price related and divide by number of companies into 100. So number of companies is 5 companies. So each company we are giving equal weight, that is 100. So 100 into 5, 500. So sigma of price relative divide by 500. If it is 6 companies, it will be 600. If it is 7 companies, it will be 700. Okay. So 10 companies means it will be 1000. Multiply with 100. That will give you equal weighted index value.
Okay, sir, thank you.
Is it okay? Any doubt?
Yes, sir, clear.
Yeah. So now we are going to the next one. So with this we are completing the index. Then we are going to the next one, next important part of our discussion. That is the return of the stock. All of you, the share is the screen is shared, but our students here.
Put it down.
Huh?
Also,
Yeah, I'll put it down. Yeah. So returns, okay. Now the rate of return. So what is called rate of return? Okay, so for example, you invested a total return. How much you that money you have got total money that you have, divide by how much that you have invested. So that will give you the rate of return. So rate of return is always expressed in percentage. Okay. So as we have discussed earlier, the return is what? See, for example, here he has invested in 2,200 rupees. He saved 2,200 rupees. He saved, and he got the return of 110 rupees. So what is his total return? 110 divided by 2,200 multiplied by 100. That will give you the 5%. That is your return. So you have deposited money in the bank, 2,200 rupees, and you got the interest of say 110 rupees. So what is your rate of return? 110 divided by 2,200 into 100. So it's called rate of return. It's called return. So as we discussed earlier, see for example here, another example, he has invested 900 and now he has got 1,050. He has invested 900, now he has got 1,050. So how much he has earned extra? He has earned extra 150 rupees. So he has earned 1000. Now the value is 1050. He has invested 900. How much he has investment increased? Investment value is increased by 150 rupees. So what is your return? 150 divided by 900. How much you have invested? 900. Multiply by 100. That is called your return. That is 16.7%. Okay. So a very simple thing that we have. So as we have discussed earlier, there are two types of return that we have. Okay. So one is you have the regular income, as we have discussed earlier, the attributes of investment, the beginning we have discussed earlier. One is called your regular income, that's called annual income, plus your capital income. Annual income and capital income. So we call them as capital gain or capital yield. So here we call it as a current yield, current income. So the current income can be what? Current income can be interest or dividend. Either you receive interest or you receive dividend. If you buy shares, you receive dividend. If you buy debentures, we receive what? Interest. So you deposit money in the bank, deposit money in the post office, we receive what? Interest. So interest or dividend is called regular income. The price changes. How much the price is changing from one year to another year. That is called what? Capital income. So if you invest in bank, there will not be any price change, because they are all non-negotiable instruments, non-negotiable, non-transferable, non-saleable. We cannot sell it. Because if you deposit money in the bank, whatever you receive, you will get back that money. 1000 rupees, when 1 lakh rupees you are investing, you will get back 1 lakh rupees. That 1 lakh rupees will not enhance to 2 lakhs. If it is enhanced to 2 lakhs, that 1 lakh rupees is called what? Interest that you receive. So there will not be change in value of money that we have invested. But whereas in stocks and debentures, since it trade in the secondary market, the money value changes. The money value increase, the investment value increase, it is called capital income. The investment value decrease is called what? Capital loss. Okay, that's what we have seen. So it's called the stocks you have stocks you have, all that we have understood. A share of ownership in a company, shareholder owns a small part of a company. So what's the return on the stocks? Return on the stock is called what? What is that? You have a dividend. Dividend is called what? Your regular income. So what is your capital income? What is the current price that you get? It's called your capital income. Okay. The stock is sold for a market price higher than what you was paid, then it's called what? Capital income. The money value decreases, then it's called what? Capital loss. Okay. So regular income can be positive or it can be zero. It can never be negative. Regular income, annual income. Okay, it can be positive or it can be zero. Either the company gives you dividend or the company doesn't give you dividend. It cannot take you back money from you. Whereas the capital income, it can be positive, it can be negative, it can be zero. The money value will increase, investment value may increase, investment value may decrease, or investment value may be constant. Okay, so this is an example for you. Okay, dividend is given for Zomato. So yesterday price I have taken. Zomato price is yesterday it was 130 now. Last week it came for IPO. It was sometimes we bought for 76 rupees. IPO price was 76. Now the price is what? What is that? The 130. So how do you calculate your total return? So total return will be what? 5 plus 5 is what your dividend income. 130 divided by 76. What is called what your capital income? Divide by 76 into 100. That is giving what? 78%. That is your return. Okay. So how do you calculate? 5 plus 130 minus 76. So 5 is what? Dividend. Your regular income. So 130 minus 76 is what? Capital income. Okay. Divide by 76. Why you are dividing it by 76? That is your base price. The price that you bought. 76 rupees you bought. Multiply with 100. Why you are multiplying with 100? To get the percentage. Okay. That will give you what? Your total return. Total return. The return is always expressed in what? Percentage. Income is expressed in what? Rupees. So what is your total income? Total income is how much? 5 rupees plus 130 minus 76. That is how much? 60, no? 60 rupees. Calculate. 130 minus 76. 64. So 64 plus 5. 64 plus 5. How much? 69. 69 rupees is what? Your total income. 69 rupees your total income. 69 rupees. Okay. So what is the percentage of return? 64 divided by 76 into 100. 64 divided by 76 into 100. So that will give you your total return. Got it? Okay. Now this is a calculation. Closing stock price minus opening price divided by opening stock price. Okay. Now this same thing for a bonds. Same thing for a bonds. So bonds are traded in the secondary market. Same rule is applicable in the bonds. So instead of dividends you write what? Interest. Interest is your regular income. Okay. Same thing is for bonds. Okay. Then we have mutual funds. Your mutual funds. Okay. So mutual funds, what is your income? The NAV value. Mutual fund is called your NAV value. Okay. Net asset value. As we have discussed earlier, doesn't have, mutual funds are money invested in what? Invested in stocks. You receive what? You receive what? What do you receive? When you invest in mutual funds, what do you receive?
Dividend.
No. When you invest, when you buy company shares, you receive what? Shares. But here in mutual fund, when you invest in mutual fund, what do you receive? Income is your what is that? Your units. Income is your dividend. I understand. For example, 5,000 rupees you are investing. So what do you receive? Do you receive shares? What do you receive? Huh? What do you receive? So I will show you my own personal example. So let me open my stock. My portfolio is open. Okay, this is there. Because I cannot connect it here. So here, anybody can see here. This is my my app, my stock app. Okay, my portfolio is here. Okay, my portfolio is here. I'll click on here. It's coming here. My portfolio is coming here. Okay. So here, what I did was I invested 5,000 rupees. I had some money, so I invested in one mutual fund. It is called NSC mutual fund. One mutual fund I have invested. I have invested in. It was a new fund offer, the beginning. So it was 5,000 rupees I have invested. So 10 rupees was a NAV value. Now what is the value today? The value today is 12.8143. 12.8143. So now what is the percentage of, what is the value today? 6406. My mutual fund value. So here, what do I get here? See, look at here. What I get here? 499.975. What is that? 499.975. What is it called? Units. I receive units. Okay? So 5,000. You want to see my value? So some stocks are trading at low because I purposefully am keeping it. Punjab National Bank and all I bought little early. It's trading at a very low price. Okay? I have very little money because I have to pay for my daughter as well, no? Expenses. So I have very little money. When she clears, so then I can start investing more. I had a lot of stocks. Now I sold it, everything. I sold it. So now it is, I have total now, at the maximum I have got only how much? 48,000 only I have. Very less money only I have. Okay. So now what I want to show you is this one only. See what you receive, what's the fund value? The fund value is called what? NAV value. So when you buy this mutual fund, first time when the companies are issuing mutual fund, what is it called? When the company is coming for first time issuing the shares, what's it called? IPO. When the mutual fund is issuing first time, mutual fund companies, AMC is issuing for first time this mutual fund, what's it called? Anybody? Online? New fund offer. Very good. NFO. NFO. New fund offer. First time. Okay. Since it has been discussed earlier, I don't want to give you marks. Who is that? Hello? We have discussed earlier all this. So new fund offer. First time the company is coming. So when the company is coming for a first time for issuing mutual fund, it is always at 10 rupees. So I went for an NFO. I bought it in last October. Okay. Last October I bought. So it was an NFO. So it was always 10 rupees. So I invested 5,000 rupees. So how many units I will get? 500 units. So it is given 499.975. So they deduct the commission for that. AMC will deduct the commission for that 5,000 rupees. Okay. So I would have not 5,000. I would have invested 4,950. That's why that fraction is coming. So not exactly 500 units is not coming because of they deduct their charges. Okay. So always it is 10 rupees. Now what's the value today? 12.978. 12.978. So how do I get my income? 12.978 minus 10 divided by 10. 12.978 is what is today's NAV value. Because it's a real time value. It's a real time value because the app is installed here, real time value. 12.978. So how do I get my income? Because since it's a new fund offer, it's only invested for say 6 months, I didn't receive dividend. So I may receive dividend when the dividend is declared. Okay. So 12.975 minus what? 10 divided by 10 into 100. The return was how much? 23.975. This is always getting updated. Okay. So since a broker is having its own app, so I get investor will have this kind of app. So we will get updated. So what is my return value? So correct? So NAV, mutual fund, how do we calculate the value? Same thing. Dividend plus, we don't put the stock price end. We have to put what? NAV value at the end minus NAV value at the beginning. Divide by what? NAV value at the beginning. Instead of stock price. Correct? Okay. Now, same thing. Then we need to, for example, so annualized return, we will come back. We'll come back for all this. Annualized return. We'll come back. Now, expected return also will come back. All this will come back later. Now we'll go for first one. How to calculate the arithmetic mean return. So please note down. Please note down this case. Now the return is given. The return how to calculate? This 10% how do you calculate? No. How do you calculate 10%? Here return is given. How do you calculate the return? Dividend plus what? Closing price minus beginning price divided by what? Beginning price. The dividend is not given. How do you calculate? Ending price minus beginning price divided by what? Beginning price. Into 100. Will give you what? The return. Here what is given? The return itself is given. The return itself is given. How to calculate what? Average return. Arithmetic means what? Average return. Okay. So please write year return. Year return. Those who are the online, please note down. Please calculate year and return. What is that? First year how much? 10%. Second year how much? 30%. Third year? Minus 20. Fourth year? 0. Fifth year? 20. Okay. So how do you get the average return? It's called arithmetic return. Arithmetic return means called what? Average. In statistics, because statistics and finance are closely related. If you don't know the statistics, we cannot study finance. So finance and statistics are what? Closely related. So how to calculate what? Average return. So how to calculate average return? Add all the return, divide by 5. Add all the return, divide by 5. So add all the return. So all the return how much? 40. Divide by 5. How 40? 40 minus 20, 20 plus 20, 40. Correct, no? So 40 divided by what? 5. Sir, 1 year is giving 0 return. Can we put 4? Oh, we cannot put. Because that year is what? 0 return. Okay? So divide by 5. So how much? 8%. All of you understood? Average return and divide by 5. Very simple, that we know. Now next one is geometric mean. Geometric mean return. That's one of the measures of central tendency. Geometric mean. Geometric mean. All these are all there in your LMS. Okay, you need not note down. All these are all there. Everything is there. You can just download it. Have you seen LMS?
Yes, sir.
It's all there. Different chapters. It is all mentioned in that. Now, geometric mean. Now the previous one. So look at this. Okay. So I'll draw the. You are noted down, no?
Yes, sir.
Okay. Now, if you put the plot here, I'll draw here value. Just 1 minute. I'll draw the value here. So, first is 10%, correct? 10%. Gone up what? 30. Correct? Come down to what? Minus 20. Then 0. Okay? Then again gone up what? 20%. Okay? There is 10, 30, minus 20, 0, 20. Okay? What is the pattern? On an average return is how much? 8%. Is return increasing? Is return decreasing? What do you say? From this chart, from this graph, what do you interpret? Increasing or decreasing? Increasing, decreasing, then increasing. So what does it mean? It is fluctuating. So it is fluctuating is a diplomatic answer. That we don't want. As a management student, we don't want what? Diplomatic answer. Diplomatic answers are given by whom? Politicians and administrators. We management students should give what? Specific answer. Our answer must be specific. Why it must be specific? Because based on which decisions are taken. Decisions are taken based on our information. Based on information, decision is taken. This particular company stock for the past 5 years, it is fluctuating. Anybody can say that. Based on this particular information, can the investor take a decision? Can he buy this particular stock for next year? Sir, here it is fluctuating. Fluctuating means what? Sometimes it may be what? Decrease. So we need to find what is the average rate of growth of return. What is the average rate of growth of return? So we have another statistical tool called geometric mean. So geometric mean provides what is the compound rate of growth of return. Okay, so that is the power of what? Geometric mean. Okay, so geometric mean is always used for what? Finding out the compound rate of growth. So for the past 5 years, what is the, whether the return is increasing or decreasing? That we need to find out. Okay, so that we have what? A statistical tool called what? Geometric mean. So how to calculate? We need to calculate the return relative. So earlier we have seen price relative. Here we need to calculate what? Return relative. Return relative. Okay. So return relative is equal to 1 plus R. 1 plus R. That means 1 plus return. 1 plus return. Second year 1 plus return. Multiply power 1 by n minus 1. Power 1 by n minus 1. That is the equation. 1 plus R. Okay. Aggregate of 1 plus R. Sorry. Multiplication of 1 plus R. Power 1 by n minus 1. So look at this example. Okay, same example. Please note down. Please note down. Online also please note down. Geometric mean. Geometric mean please note down. First year 10%, 30%, minus 20%, 0%, 20%. Okay. So how to calculate return relative? What's called return relative? 1 plus R. Return relative is called what? 1 plus R. So 1 plus R. What is R? 20%. Okay, 0.10. So 1 plus R means what? 1.1. So how do you get 1.1? How do you get 1.1? 1 plus 0.1. How 0.1? 10 by 100. This is a percentage, 10 by 100. So 0.1. All of you understood? Is it clear? Is it clear? 1 plus 0.1. So 1.1. Second one? Second one? 1 plus? 1 plus? 0.3. 1 plus 0.3. So how much? 1.3. 1.3. Third one? 1 plus 0.2. No, 1 plus minus 0.2. 1 plus minus 0.2. How much? 0.8. Is that clear?
Yes.
Is that clear? Fourth one? 1 plus 0, 1. 1 plus 0, 1. Fifth one? 1.2. 1.2. Multiply. Multiply. 1.1 into 1.3 into 0.8 into 0.1 into 1.0 into 1.2 power 1 by 5. Because this for this we need to use a scientific calculator. Because scientific calculators are allowed in the examination hall. Scientific calculators are allowed for you. Only the usual calculators, scientific calculators are used. Okay. So you have to use scientific calculator power 1 by 5. Otherwise you will use a log table. So log tables is a very cumbersome work. So we can use scientific calculator. So 1 by 5. How 1 by 5? How many years? 5 years. But 3 years? 1 by 3. Minus 1. Minus 1. So what is that? 6.54. What does it mean? What does it mean 6.54?
The compound growth of
The return of the stock for the past 5 years is increased by 6.5. The return is not fluctuating. The return is what? Increased. That's why this gives you what? Positive value. So it's increased by 6.54%. So does the investor invest? Yes, it gives you the positive return for the past 5 years. Though 1 year it gives you minus 20%, another year it gives you 0%. The remaining 3 years it's growing. So on an average, for the past 5 years, it has got compound growth rate of. The term is what? Compound growth rate of 6.5. So here the variable is what? Here the variable is return. The variable can be sales. The variable can be profit. The variable can be revenue. The variable can be population. The variable can be GDP of a company or GDP of a country. It can be of anything, any variable. So geometric mean provides always what? A compound growth rate. How, revenue of a company is increased over 5 years. We don't give what? Average growth rate. Always we give what? Compound growth rate. On an average, how the company revenue has increased, profit has increased, sales has increased. Okay. So geometric mean is a very, very vital statistical tool in management for taking decision. Okay. So how to calculate? How to calculate? Return relative you have to calculate. Return relative 1 plus. You have to calculate. Multiply power 1 by n minus 1. Okay. So which is more powerful? Geometric mean or arithmetic mean? Geometric mean. Geometric mean is always less than arithmetic mean. Geometric mean is always less than what? Arithmetic mean. So here it is 6.54. What is the arithmetic mean? 8%. It is always less than, provided the data is what? The data is random. You have a random data. Okay. So arithmetic mean is more appropriate of measure of performance over a single period of time. On an average, 8% is the return. Geometric means a better measure growth in wealth over the period of time. Okay. So So geometric mean is always less than what? Arithmetic mean, except when all the return values be considered to be equal. Okay. Yeah. Now, is it clear? Geometric mean, arithmetic mean, all of it clear? Okay. So some more exercises are there in the the LMS. You can practice. Okay. Now, two stocks. Look at these stocks. Two stocks value increasing. It's a fluctuating or increasing? Fluctuating. Look at this particular stock. Another stock also what? Fluctuating. Okay. So how to invest? Which company you have to invest? Very difficult. You have to find out. So both has got what? Both the companies got say 31% average return. So which company we'll have to buy? Which company stock we'll have to buy? Okay. That is a decision we'll have to take. Because both gives you the average return is same. 31% is giving average return. Okay. So what we have to find out here? Okay. So we'll have to find out what? How risky it is. Okay. So stock B, it is what? Stock B return is what? More or less what? Constant. Stock A return is what? Fluctuating. So we need to find how the particular stock is risky. Okay. The risk is another factor that we need to consider before we take a decision. So always the rule of thumb is the risk is higher, the return is higher. The risk is higher, the return is higher. The risk is less, the return is less. Okay. Zomato, today also Zomato has reported a 350 crore loss. 350 crore loss. Company has reported 350 crore loss for the last quarter. Okay. Despite the company is giving a return in the market. Okay. So investors have taken a very huge risk in investing it, though the company is reporting losses. Okay. Because they get a return. Though the company is reporting loss, they take high risk for buying this company share, and they got a return of, everybody is getting 78-60% for within 1 month. So which stock, which asset will give you such a huge return? No, asset will give you the huge return except stocks. Okay. So we'll have to calculate what? The risk of each stock. That we will take it up tomorrow. Okay. So thank you very much, dear students. We will take up next session. Risk of a particular stock. We'll go for a calculation. So thank you very much. We will see in the next class. Thank you.